All right, let's dive right into this explainer. I'm officially putting on my expert bookkeeper hat today to help you untangle the frankly messy numbers of Amazon settlements so we can build you a pristine financial system. Look, if you're selling on Amazon, you already know it's a massive engine for revenue. But what they don't always tell you is that behind the scenes, the financial data is this tangled web that can totally blindside you at tax time if you aren't prepared. So today, we're going to look really closely at how to handle your Amazon bookkeeping with absolute precision. Specifically, we'll look at how to leverage an automation tool called PayTraQer to do the heavy lifting for you, hopefully giving you back a ton of your time and, honestly, your sanity. So here is our quick syllabus for today. First, we're going to diagnose the core issue with the Amazon bookkeeping trap. Then, we'll establish the core rules for clean books, discuss exactly why accrual accounting wins, and walk through automating workflows with PayTraQer. Finally, we'll wrap up with configuring your sync settings and locking it all down with the monthly reconciliation routine. Okay, kicking things off with part 1, the Amazon bookkeeping trap, and untangling that infamous biweekly settlement. I've got to ask you this right out of the gate because recording your net bank deposit as your revenue is absolutely the single most costly mistake an Amazon seller can make. You know the drill. Amazon holds your money, they deduct their fees, and they send you a netted out deposit every 14 days. It is so incredibly tempting to just look at your bank feed, see a deposit from Amazon for, say, $4,000, and just categorize the whole thing as Amazon sales. But if you're doing that, you are actively destroying the accuracy of your financial records. The crucial takeaway here is that an Amazon payout isn't just one number. It's a bundled knot of data. Just looking at that net deposit creates a really dangerous illusion of how your business is actually performing. Think about it. If you record an $80 deposit as your revenue, but the product really sold for $100, you're understating your top-line revenue. And worse than that, because you didn't record that $20 Amazon took in fees as a separate expense, your profit margins look artificially inflated. You are basically flying blind.
Let's break down why this happens. Amazon is literally slicing off 20 to 30% of your revenue through a bunch of varied fees before a single cent ever hits your bank account. Your payout has already been stripped of FBA fulfillment fees, an 8 to 20% referral fee, warehousing costs, refunds, and your pay-per-click ad spend. If you aren't breaking these specific costs out, you have absolutely no idea which products are actually making you money and which ones are just bleeding you dry.
Which brings us to the solution. Section 2. Core rules for clean books, the true foundation of e-commerce accounting. You honestly don't need a super complicated system to fix this, but you do need a consistent one. These 4 steps form the non-negotiable bedrock of our bookkeeping blueprint. First up, never mix your personal and business finances. It makes reconciliation a nightmare and creates massive audit risks. Second, like we just talked about, always record your gross sales. Third, you've got to break out every single fee into its own category in your ledger. And step 4, perform a strict monthly reconciliation so you aren't left with a terrifying, massive cleanup project at year end. All right, moving into section 3, why accrual accounting wins. Because in e-commerce, timing really is everything. To make this blueprint actually function, we have to talk methodology. Accrual accounting is the industry standard for a reason. It stops your 14-day Amazon payout lag from totally distorting your monthly profitability. Let's say you sell 1,000 units of inventory on January 30th, right? But Amazon doesn't actually pay you until February 12th. Well, cash accounting makes January look like a massive loss and February look like a huge win. Accrual accounting fixes this entirely by recording the revenue exactly when the sale happens, perfectly matching their income against the cost of the goods you literally just sold. Now, how do we actually do this? Section 4, automating workflows with PayTraQer and bridging that architectural data gap. Let's be real. Doing all this manually is impossible at scale. You cannot sit there and manually type out hundreds, let alone thousands, of order lines and fee deductions from Amazon's complex reports. As a bookkeeper, I always look for an architecture that handles high-volume data pipelines smoothly, which is exactly why PayTraQer is the standard recommendation here. The setup sequence is super straightforward. You just pull the app from the Intuit App Store, link it up to your QuickBooks Online file, and then log into Amazon Seller Central to authorize the API. This creates a highly secure, read-only bridge. It lets the software automatically pull your settlement reports, map the data, and push it perfectly formatted right into your accounting ledger. Okay, on to Section 5, configuring your sync settings. Because tailoring that data flow is where the magic really happens. Listen, middleware is only as smart as the rules you give it. A bad sync can actually create more cleanup work than doing it by hand, so selecting the right mode is vital. If you're a high-volume seller processing thousands of orders a month on Seller Central, Consolidated Sync is an absolute must
to prevent your QuickBooks ledger from lagging. You do not want thousands of individual sales receipts clogging up your system. Consolidated Sync neatly bundles a whole day's or settlement's worth of data into a single, clean journal entry. On the flip side, if you're using Amazon Pay as a checkout on your own personal Shopify store, you'll definitely want the Itemized Sync to capture those specific customer-level details.
Next up, you absolutely have to set custom mapping rules. This routes specific Amazon fees into dedicated expense accounts, so you can actually analyze your costs. Inside PayTraQer, you'll want to map referral fees to a specific commission expense account, FBA fees to a fulfillment account, and, this is critical, map Amazon's reserve holdbacks to a dedicated asset account. That's the cash they keep to cover potential returns, and you need it in an asset account so you always know exactly how much of your money Amazon is just sitting on.
We're in the home stretch now. Section 6, the monthly reconciliation routine to completely secure your numbers. This is the final piece of our blueprint. The monthly review is the process that guarantees your automated data actually matches reality, because even with brilliant automation, a bookkeeper's job is to verify. The linchpin of this entire system is what's called a clearing account. Without this sort of financial waiting room, your bank fee will never, ever balance against Amazon's reports. Think of the clearing account like a virtual bucket. The software dumps all your gross sales into this bucket, then reaches in and pulls out the FBA fees, the refunds, the ad costs. Whatever is left sitting at the bottom of the bucket, that's the exact net amount that gets transferred out to your real-world checking account.
So following these 3 quick steps every single month ensures you catch any missing reimbursements and totally zero out any discrepancies way before tax season hits. You pull the actual report from Amazon, check it against with the software synced into your clearing account, and finally, you just click Match in your QuickBooks bank feed when that net deposit arrives. Simple as that. It should literally tie out to the penny.
Ultimately, the whole point of this explainer is to get you to a place where clean books let you instantly spot a losing product before it drains your cash flow. Because at the end of the day, your financial reports shouldn't just be collecting dust. When your sales, your fees, and your inventory costs are accurately synced and categorized, your profit and loss statement basically becomes a crystal ball. You can see right away exactly which SKUs are highly profitable and which ones are just getting eaten alive by storage fees or a high return rate. So I'm going to leave you with this final thought. Do you truly know your exact profit margin right now? Implement this blueprint. Let the software do the heavy lifting for you and finally find out exactly what your business is really making. Don't let your e-commerce growth be stunted by bad data. Take control of your numbers, set up your systems, and just watch how much easier it becomes to scale your business. Thanks so much for joining me on this deep dive, and I will catch you on the next explainer.